and now we're doing budgeting, and I think budgeting is one of the fun things of cost accounting. And I hope you like it too. It's fairly straightforward. So let's get started. And I think you can probably do most of this yourself with just a little guidance from me. The first one talks about mountaineers selling rock climbing shoes, and they expect to sell 4,000 pair at $165 each in January and 2,000 pair in February. And all the sales are cash. And this just simply wants you to give them a sales budget. So, the sales price, the number of pairs, and then the total sales. Same here and here, and it should add up to 1,100,000 in sales. So then, I guess we were prepping you here. You're going to review the results in one, and they want to now figure the cost of goods sold. And they are telling you they expect to sell 4,600 in March for $240. And their targeting ending inventory is $18,000 plus 45% of next month's cost of goods sold. Now that's a whole lot of numbers here. So let's kind of back into it and see what we've got. First of all, our cost of goods sold for January and February is what? 75% of something. 75% of the sales revenue. So we'll take the sales revenue here and take 75% of that. So it's 75. Let's just type that out there. Did I spell it right? Oh, horrors, no. So it's 75% of sales. So it's going to be 75% of here for January and here. So, and then their desired ending inventory is a little trickier because it's going to be $18,000 plus where was I? So, $18,000 plus 45% of the COGS for the next month. And you kind of go, huh? So what does that amount to? How do you figure that? Well, you got to find the numbers. 45% of the cost of goods of the next month. So you've got this month, which is $495. I'm giving you numbers here. And February, which is 75% of the sales of $440, is $330,000. So you're going to take 45% of that and add $18,000 to it to come up with the desired ending inventory, which is going to be $166,500. So that gives you the total inventory required by adding these two, and you will subtract the beginning inventory. And so now what the beginning inventory is the ending inventory, right, of last month. So what we want to do is take 18,000, this is 18,000, plus 45,000 of this 4,000 or 495,000. So that gives you 240,750 in that position. So if you add this all up, you're going to come up with, minus that, okay, come up with the purchases of 420,750. And you can do the same thing for here. So where do I get this number? They give you the sales right here. You're going to have to calculate that sales and multiply it by 75% and then multiply that by 45% to come up with this number. Your beginning inventory is going to be this number right here, because that's our desired ending inventory. So you'll just carry that forward, and then that will complete that year. So that's kind of a tricky one because there's a lot of calculating you have to do. And quite honestly, when you're doing these, all of that calculating you don't even notice because you know exactly what you want to do. So let's go to the third one. And the third one is looking at a sales budget. We need to look at the sales budget we prepared in exercise 1 and assume sales are 20% cash and 80% credit. And it indicates their credit sales collected as follows, which is nice. And November sales totaled 386 and December sales totaled $399,500. Then we need to prepare a schedule of cash collections. But you should fairly well be able to come down and literally multiply this out using the numbers they give you without too much issue at all. So it should be fairly straightforward, but I gave you the numbers, okay? The 80% of the sales from the current month, 80% of the sales from the prior month, which would be this December figure, and 80% of the sales for 2 months prior, which would be this 386 figure times 80%. And you'll use these numbers over here, but you'll move them up or down. Let's see, you'll move them down. This will be 1 month ago, this will be 2 months ago, and that one will drop off. And you'll use February's budgeted sales figures here. So, and that will come from up right here. So you're kind of jockeying all over the place. But when you get all done, you should have these total cash collections. Here's the numbers to go. And this is your total credit sales. So give that a good try. And email me if you have, or message me if you have trouble with that. Let's look at 4. Again, like I said, these are kind of fun. This one is literally, all you have to do is drop these numbers down. And if you get them in the right order, and they're fairly easy to do, you will have a deficiency of $13,430 for this one. Kind of giving you hints along the way. Number 5, let's see. This is very easy to do. You're just going to take your 40,000 here. You're going to take your percentages, and it's going to change June, obviously. But remember, it's also going to change the April through June total, so you'll have to add that up and recalculate that. Number 6 is looking at performance, and we're just calculating variances. This, the budget, is your base. So this is going to look like, and we're looking for variances for, compute the variance of the budgeted amount, and then give some suggestions. So what we're looking at are variances for sales revenue, cost of goods sold, and for gross profit. And give this some thought. What would you think after you've created a budget like this? This is what's actual, and this is what occurs. So what questions would you ask? Yeah, number 7 is, again, a very fun one, because you are using all these numbers. This total effect of financing, this is the amount you're going to borrow, okay, to bring everything up to the where you want it to be. You have an excess here of 1,000. You have a deficit here of 500. So fill that out and bring those numbers down and read all of that. Again, email me with questions. We've given you some hints along the way. And this is number 8, and this one's kind of fun also because you're going to do a lot of calculations and you're going to end up with a budgeted income statement here. There's nothing too difficult about this. The only problem you're probably going to have, and I've laid this out for you so it's much easier, you're going to have to figure the purchases first here, and I've given you the numbers to do that. The ending inventory is 9,000 plus 25,000 plus 25% of the sales of next month. So I've kind of already put that calculation in there for you. And then sales is calculated here. This is how the sales are calculated. So that should, and once you get the cost of goods sold, okay, then you're just going to transfer this information down to here and try to lay out a budgeted income statement to kind of have an idea of what your loss or your income would be. Now, be very careful when you do this one to make sure that you round up after $50 or round down anything less than $50. So if you are confused about that, you can message me or just put in the real exact amounts and we'll go from there. I think you should have fun with this one. Again, message me if you have any questions whatsoever. There's nothing funny about this. Here's your calculations for the salaries. And then here's your income tax expense right here. And then we've given you 2 check figures and more check figures here. So if you get off a little bit, you'll be able to go back and find that very quickly. And that's budgeting, and this is a very good exercise in budgeting. So, thank you. Have a good day.